Good evening, everyone. Thank you for this opportunity. I'm going to put my reading glasses on in a minute, but I really have enjoyed these sessions. Last week's session was the bomb. So if by chance you missed that, you need to get the recording. But I hope to provide just as much valuable information tonight, talking about life insurance and retirement. Like she said, I'm Wanda LeBray Rubama, and I've been in this space here for about 17 years. And this is something I'm very passionate about and I enjoy. So let's talk a little bit about retirement. Most times when we think about retirement, we're always talking about investing. And that's what we call the accumulation phase. This is where we put all the work. This is where all the hard, long hours and time go into. This is our heavy investing stage. We want to make sure that you start early at this stage, the accumulation, because the longer you have to have your money in the market, the longer it has to grow. And then also to recover from volatile markets like we've had recently. However, when you get to a certain point in your retirement planning or a certain age, we also need to consider these other two phases. Phase two you need to consider is the preservation stage. And that's when after the years of working and you've put into that accumulation phase, that you want to start reevaluating your goals. So that comes at a certain age, or it comes, hope you can hear me. Can you hear me?
Yes.
Okay, good. All right. Comes at a certain age or when you're getting close to that retirement time and you want to take fewer risks. So right now at that preservation stage, you want to start reevaluating your goals. And then finally is the distribution stage, which means retirement is right at the front door. And this is how you're going to start taking your money or taking withdrawals from all of that hard work. So briefly, I've shared with you three phases of retirement. I've shared with you the accumulation phase, which is your investing phase. I've shared with you the preservation phase, which is the phase where you're getting close. You're meeting with your financial advisor. You're making some decisions. You may not be taking as many risks as you would have taken when you were younger. And then we talked about the distribution stage. And that's when you're right there. You need to start meeting with your financial planner as often as possible, because this is the phase where you start taking your money and your withdrawals. But I really believe one of the best kept secrets in retirement is life insurance. Life insurance to me is one of the best kept secrets for happy retirement. Now, this is my disclaimer. Everything I'm saying today is not for everybody, but you will need to speak with your financial advisor or financial representative to make that determination as to what your goals are and where you want to be when you retire. But every sound financial plan begins with a strong foundation, and that foundation is life insurance. That should be the foundation or the cornerstone of any type of financial plan, okay? And I know many of you know my story, and I'm not going to go into that today because I want to make sure I save time for Ray. But, I'm now 53, but my first marriage, I lost my husband at 37, and I think we were only married 3 years. And did I have life insurance in place? I did. Did I have enough life insurance in place? I didn't. But it was enough to get me started, and it was enough to replace his income until I could get my feet back on the ground and get going again. So tonight, I'm talking about life insurance. I'm going to give you a few tips on retirement and protecting your family. Allie, I'm ready. So most of us know that there are two types of life insurance. Okay. All right, there we go. Two types of life insurance. There's term insurance, which means it insures you for a period or a time. It can cover anywhere from 5 to 30 years, and it's simplistic. It's simple, okay? Then there's permanent insurance. This is a term for life insurance policies that do not expire. Most permanent life insurance combines both a death benefit with a savings account. And there are different types of life insurance. I would suggest, if it's affordable, that you have a combination of both. But if it's not affordable, then you start with term. As you get on and you start increasing your salary or bringing in more money, then you might want to consider some permanent insurance, because permanent insurance is always there. No one wants to be a GoFundMe case. So we have to make sure that we have some type of life insurance in place to protect us and our families in the event something happens to us prematurely. Allie? All right, so in my agency, one of the things that I've structured is this triple play. And I come from a family of athletes. Our favorite, back in that time, what our sport of choice was softball. All right. So we grew up, my sister and I grew up playing softball from an early age up into adulthood. And so this is my triple play concept for financial planning. Why do I call it a triple play? Let me tell you a little bit about baseball. You know, when you hit the ball, you're at bat, you hit the ball, and you're going to get one base. People are rooting for you. Your teammates are rooting for you. But when you round first and then somebody bobbles the ball and you can make it a double, boy, I'm telling you, the crowd gets behind you then and your teammates. But then when you round second and you can make it a triple and you hit third, people are yelling, get there, get there. And your teammates are jumping up and down. That makes you feel good. So when I thought about how I can explain this to people, I explain it in a way that I understand, because I've always played baseball and softball, and I know people can relate. So when you get to that triple, your teammates are rooting you on. The crowd, it gets louder there. So this is a triple play planning tool that we can use when you're talking about retirement and financial planning. And this is what I call an index universal life. This may not be the one for you, but if it's structured properly, it can give you a lot of benefits. And so one of the great benefits is it can provide for you tax-free supplement to your retirement income. So if there was a way to pull out income tax-free as a supplement to your retirement, would you want that? I can't see anybody's face, so I don't know if they're talking back to me or not, but I'm hoping tax-free rings a bell to you. What if you can have a tool in your retirement portfolio that also gives you living benefits in the form of chronic and critical illness? A rider that would give you some type of care if something was to happen to you terminally. And what if there is something in your retirement portfolio that could provide a tax-free death benefit and a legacy to your family in the event that something happens? So when we talk about permanent insurance, this is one of the tools that I use, because I believe you can get a triple play just from one product. Also, you must know that the cash value that you build up inside your life policy can be used on this journey that we call life. When changes come, when things happen and you just cannot get your hands on enough money to take care of that need, you can look into your permanent life insurance to provide that as well. So this is my triple play: tax-free supplement to retirement income. You can have a rider that gives you chronic and critical illness care, and then tax-free death benefit to your family if something was to happen to you prematurely. All right, Allie. All right, so just to give you an analogy, I'm going to share with you how times have changed. as a part of this retirement planning, I don't know, I'm sure there's some people on the line that remembers this. Do you remember when a telephone was just used for a telephone? Or your Walkman down there was just used for a Walkman when you're exercising? Or if you wanted to surf the internet, you had to go to your computer and sit down. Somebody's saying yes to me. I got an amen on that. How about the camera? You remember you had to get the film to put in it and then wait for it to come out, and then you have to dry it off. So that's this is a screenshot to tell you how things and times have changed, because Allie, the rise of the smartphone. The rise of the smartphone. One device, many applications. So on this device, you can do everything that the Polaroid, yeah, you can do everything that we used to use one device for. So the smartphone, you can make phone calls, you can take pictures, you can play music, you can send emails. All of that can be done right from the palm of your hand. Now, Wanda, you're supposed to be talking about life insurance. How does a smartphone and life insurance have something in common? Go ahead, Allie. Well, just like we talked about, my triple play, there is life insurance that can give you multiple things and not just a death benefit. A lot of people remember life insurance as just that death benefit, but life insurance can be so much more. And it has changed over the years, over the time since I've been in the industry. And you can get so many things from one life insurance policy that you never knew about before. And that's why I think this is one of the best kept secrets to a happy retirement, a permanent life insurance policy. All right, Allie. Like I said, it's more than just the benefit. It's more than just the death benefit. This triangle tells you that if you pass away prematurely, permanent life insurance, if you've had it long enough and if it's structured properly, can provide you income. So when I lost my husband, it allowed me income to start all over again. Now, I wish it had made me wealthy, but it didn't. But it gave me income to start all over again. And I was in the process of buying a new home. So we didn't have to stop that process. We could continue on that process because he would have wanted that. So life insurance is more than just the death benefit. It can provide that income that you need if your primary wage earner passes away. It also will allow you to draw from it if you can tap into your death benefit. If you ever become chronically or critically ill and you need some of that, you can draw off of that if that ever happens to you. And it also provides a savings. It says down here, I think it says 42% of the surveyed people that were surveyed are iffy about whether or not they're going to have enough money when it comes to retirement, or if they're going to outlive their savings. So then you have a cash value build up in your life policy to supplement that retirement. All right, Allie, I'm ready. So hence the Index Universal Life policy. It gives you many benefits in one product. And it may not be the Index Universal Life policy for you. It could be anything. It could be a universal life. It could be a variable. It could be any whole life. It could be anything. But this is a permanent policy that gives you these additional benefits all in one policy. Okay. Okay, Allie. So right here, what you're looking at is a graph of the history of the federal tax rates. I don't know if you can see me. Can they see me, Allie, pointing? Okay. All right. So if you look at this graph, you can tell from 1915 to 2020 how the federal tax rates have gone. And right now, they're down at some of the lowest tax rates we've ever had. What I will tell you, if history repeats itself, it will not always be there. But why am I sharing this information with you? Because we need to pay close attention to the federal tax rates because they affect your bottom line, such as your investment portfolio that you're putting aside for retirement. Okay. Why is this important? Allie, let's show them why it's important. All right. So you are considered an investor. And most people only think about the accumulation phase of investing. So all you're thinking about is putting money aside for retirement. But we also got to think about when you're taking money out for retirement. So most investors, there are 3 tax buckets for investors. And most people, we kind of diversify how we're investing in these 3 types of buckets. You have what we call the taxable bucket, deferred bucket, and the tax-free bucket. The taxable bucket is when you make your contributions and you don't get a tax deduction. The income that these investments generate is subject to taxing once you pull it out, like a capital gain tax. So, for instance, if you have a share of stock, or you have mutual funds, or if you sell real estate, I used to be a real estate investor. All of that, a parcel of land, you could generate a capital gains tax when you sell the item. So we have a bucket for taxable items. We have a bucket for tax deferred items. And with tax deferred is when you make a contribution, you get a tax deduction. The investments inside this account grow tax free. But when you withdraw, it's going to be subject to taxing. And that examples of that would be your IRA. It could be your SEP. It could be your health savings account. It could be your 401k. So when you put money into your 401k, it's pre-tax money. But when you start taking it out at your distribution time or phase, it's going to be taxed. And that's why we looked at that graph before this, because if taxes go up, then that means you're going to pay more money on those taxes on that money when you start withdrawing. Okay. So then we have a tax-free bucket. Can somebody put free in the comments for me? I should see a couple of those. Free. Okay, Allie, thank you for helping me out. All right. Oh, Sissy up here. Okay. All right. Tax-free. Thank you. Thank you. The investments inside this account grow tax-free. And when you withdraw money from this account in the future, it comes out tax-free. Guess what type of investments can go into this tax-free? Life insurance is one of them. A Roth IRA, because you're paying this with after-tax money. I don't know if anybody has a Roth IRA, but you don't get to write that off on your taxes because it's money that it's after-tax money. So, but we like free. So as much money from these buckets that we can get into the tax-free bucket, it's going to benefit us in the long run. And so when we talk about a permanent life insurance policy, that's why I like it, because it either can offset the cash can offset some of that, the taxes you'll have to pay in the future, or you can use it as just a supplement for your retirement. And you can use it on this journey that we call life. So it's money that you can use while you're still living. That's why life insurance has changed so much. It's more than just the death benefit. It's money that you can use while you're still living. We, for example, have used our money in our life insurance to help our boys in college. When I made a transition in life to sell my business and I want to pay off my car, I borrowed against my life insurance to pay the difference on my car so that, it's not coming out my savings. I'm not, liquidating all of my assets, but it's tax free. And then all I had to do was pay myself that when I started making more money. All right, call that more money. Wanda's going to be making more money. Y'all speak to me. All right. So the buckets are important because we need to know where our money is. And most times it's diversified through these three buckets. The tax graph is there because you want to make sure you want to make sure that you know where the tax brackets are, so that when you start withdrawing money out, that you're not paying, or you can mitigate those taxes by meeting with a financial person, talking to somebody to help with that. Okay. All right, so Allie, let's go to the next slide. I know I'm running out of time. These are things what we talked about. What's in the tax-free bucket, what's in the deferred, and what's in the taxable. We want to try to move as much money as you can to the tax-free bucket. And that's why I love my life insurance policy. It does not apply, thank you, does not apply to term, because term does not grow cash value, okay? You don't have any cash value in the term. All right. Allie, go to the next one. All right. So the benefits, and I've talked about this over and over again, the benefits of a permanent life insurance policy is it gives you additional income. My husband, who says he didn't have anything until he married me, he had something. He just didn't know what he had. That's the problem. So I was the one to help organize it, put it together. He had it. He just didn't know what he had. I mean, he had a life insurance that had cash value. He didn't realize it until we got into this crunch, and Robbie needed money in college, and we had to make up the difference from what his scholarship didn't have. So it gives you income to income replacement. It gives you retirement income to supplement your retirement. It could also give you a long-term care rider, because you can tap into this for living benefits. It's called critical and chronic illness rider, wherein if you ever become diagnosed terminally with cancer, anything, you can tap in to get some of your death benefit as a part of this permanent insurance policy. And then the money that comes out, as long as we take it out properly, can be tax-free. All right. Okay, so Allie, I know I'm running out of time. We can, if people want to know more, we can talk about it later, but chronic and critical illness rider, if you ever diagnosed not being able to do 2 of the 6 activities of daily living, that's what they are. Critical illness, what it could cover: cancer, heart attack, stroke, Alzheimer's, dementia, and that's what it could cover. Allie, go ahead. All right. So quickly, and I'm not going to go through all of these, but what are the odds? The odds of your house burning down between now and the day you die are about 3 out of 100, 3%. We all have homeowners insurance. All right, Allie. So, all right. The odds of your, listen. All right. Thanks, Allie. The odds that you will need some type of long-term care between now and the day that you die are about 72 out of 100. And less than 30% of the Americans have, over the age of 45, have purchased some type of long-term care. Long-term care is really expensive these days, but if you have some type of life insurance, you can get almost the same kind of care through your life insurance as a rider, okay? We don't like that odds. 72 out of 100, they're saying that we are going to need some type of care. All right, Allie. All right, and what they're saying it's going to cost to cover a married couple over 65 for long-term care needs over their lifetime, $343,500. Where's this money going to come from? We don't want to have to sell our assets. We don't want to have to, take all of our retirement income, all the things we've worked for to pay for this. We want to make sure that we've planned for this properly. And then we won't have to worry about this when we get into our golden years. Allie? All right. Permanent life insurance policy could be a part of your retirement planning strategy. You know, it's really totally up to you and your financial advisor. For me, I think it's the best kept secret. People don't buy it because they don't know the benefits of it. And really, buying it is an understatement, but you need to make sure that your family is protected. Losing my husband's early in life insurance allowed me to bury him with dignity and provided a replacement income because I no longer had his salary. Also, it offers the potential of cash accumulation. You can use this money for all different things. Also, you can borrow against your cash value policy and take income out tax-free for things in life that could cost. Just like I told you, kids going to college. I wanted to pay off my car, a medical expense that has come up. You can use this while you're still living. And you can access, you also have access to a portion of your death benefit if you have ever been diagnosed with a terminal, chronic, or critical illness. I think life insurance is the best kept secret. Permanent life insurance that has cash value build up should be, or I say should be, one of the tools that you use in retirement when you start thinking about planning for your future. Allie? And I guess that's it. I tried to rush through a little bit because I know Ray's gonna put the icing on the cake with the Social Security. And I wanted to make sure that I gave him as much time as possible. But if you have any questions, you can put them in the chat and we can go back to them a little bit later. I'm gonna hand the floor back over to Allie so that she can bring Ray on. Thank you.
Thank you, Wanda. That was fantastic information, and we appreciate you just sharing your knowledge and expertise with us. We're so grateful to have you. And I am going to stop sharing my screen really quick, just so I can share a new screen here with you guys as we bring Ray up to the virtual stage, for lack of better words. So just give me 1 second, guys. And Ray, if you want to come on up here. And Ray has also generously agreed to go, and correct me if I'm wrong, Ray, I don't want to put you in bad position here, but to go a few minutes over 8 o'clock. So I know normally we end our sessions at 8 o'clock, guys, but there's just so much great content here. And I know there's been so many great questions in the chat that we want to best serve you guys. So I will stop talking so Ray can have the floor. So Ray, good luck, sir.
All right. Well, thank you. Can you hear me okay? Can you hear me?
Yes, we can hear you.
We can hear you.
Okay, great. Thank you. Well, thank you, everybody. I really appreciate it. I'll just kind of start from the top. Wanda did a great job explaining the powerful benefits of life insurance. So I highly recommend, reviewing your program. I'm going to take a deep dive, but really at a high level with 5 key points on Social Security. Just as a background, again, my name is Ray Henderson. I'm a certified financial planner, and I've been doing this for a long time. I probably look much younger than you might think, but I have 4 sons from 20 years old down to 8 years old. My wife and I have been married over 21 years. So Social Security is a big topic. And so what I think may be helpful is to open the floor if there are questions along the way. But these are going to be 5 things you need to know. This is a public presentation that you could pull up later, or I could send to you. But let's just dive in and see what questions we have. So Ali, let's go to the next slide. Okay, so topics for today. There are some quick facts I'd like everyone to know about Social Security, whether you're still working, even maybe just started off working and are younger, or whether you're even fully retired and already collecting. There are just some things to know. So we'll go over some quick facts. There are some key risks in retirement that I want to make sure we cover, and some planning that you can do. And then just understanding the fundamentals. There are some specific fundamentals that we all want to know and want to be able to tackle. So let's go to the next one. Okay, quick fact. So Social Security is a large undertaking. About 70 million Americans are receiving benefits to the tune of $1 trillion a year. I don't know if we ever think about it as being that big, but the US government has a big promise there. The average monthly benefit is $1,544. So let's just pause there. What is Social Security? It really is a source of guaranteed income for the rest of your life once you've reached what they call full retirement age or early age. That's really designed to be a pension, similar to a military family or a federal government pension. Social Security is a guaranteed income source that we all pay into as workers, W-2 earners. A portion of your taxes is funding your future Social Security benefit. For over 60% of elderly beneficiaries, it's actually the majority of their cash income. So it's a large dependency that we have on Social Security. But one of the it's not a myth. One of the truths that's out there is that is Social Security going to run out of money? That's one of the questions we get a lot. It is projected to be exhausted in the year 2034, but that does not mean what it sounds like. Every year, workers put money in the system. Every year, retirees take money out of the system. So what's happening is the reserve is drawing down, but there's still new money going in. What's likely to happen if nothing else changes in the law is benefits may have to be reduced by roughly 25%. That's what's alarming. It's less likely to happen to those already receiving them, but those who have a promise to receive them in the future, you're still 40, 45, 50 years old, still working, those benefits might have to go down from what they were promised. Let's go to the next slide. Okay, so what are they doing about this, right? This is a problem. We don't want to take Social Security if it's not going to be, or we don't want to work all our career and then not receive what we expected. There are a lot of things in the works to try to fix the problem. However, it all involves increasing something that honestly we would feel would still be painful. So payroll taxes going up, pushing out the retirement age. It used to be 65, now it's 67. Adjusting the cost of living. There are several things that are in the works in terms of how they're going to try to address this, but 2034 is only 12 years from now. It used to feel so far out, but we have some legislation that needs to pass. Let's go, Allie. Okay, so let's kind of summarize again. How does it help you? There are some key risks in retirement that we all need to address. One is longevity. We honestly greatly underestimate how long we may live. Many of us may have loved ones who've lived longer. The average retirement age is pushing out, but also longevity. We're living longer, even if we're not living healthier. We're often, many of us are living longer. Inflation, there is a built-in increase to Social Security. So when you take that benefit kind of locks in. So the feeling or the benefit of the inflation, you're going to feel that more if you plan your timing with it. One thing is Social Security is not affected by the markets, right? It's not changed by what's happening in the stock market or the bond market. And then there can be preferential tax treatment. You want to work with an advisor or a planner who can coordinate your income. If you have IRAs, 401ks, 403b, mutual funds, real estate, look at that picture as a whole, because taxation, you don't want to give more to the government than necessary. And as we said, it's a guaranteed stream of income for your lifetime. So let's protect it. Next slide. Okay, here's some fundamentals. So in order to qualify to get a future Social Security benefit, you have to work at least 40 quarters. That sounds more complicated than it is. You only have to make $1,500 every 3 months. $1,510 constitutes 1 quarter. Now, if you're self-employed, well, I know many individuals who are self-employed and writing off a lot of their income. Whatever you pay taxes on after all those write-offs is what's helping your Social Security benefit. So being a self-employed individual, I'm always a proponent of getting some advice from a tax accountant, because I'm not necessarily going to say, let's just write everything off. You want that income because Social Security is going to build up. If you don't pay into it, you won't have it later. You're based on your average monthly earnings over 35 years. So a nice long work history helps you. And there's also spousal benefits, which we'll get into a little bit later, and survivor benefits. Next slide. Okay, so this is the meat and potatoes. This is what really, really matters with Social Security. Again, no matter your age, if you write nothing else down, please write this down. FRA, full retirement age. It's kind of that magic number that drives the dollar amount you see at the top of your statement. So if you go log into your statement online, SSA.gov, Social Security Administration.gov, you're going to be able to see an electronic version of your statement. But based on what year you were born in, whether it's 43 to 54, 55, 56, etc., your full retirement age is different, maybe even from your spouse's. And this is key because full retirement age drives a few things. The number you see in your statement is based on full retirement age. What you'll see later in the presentation is most people don't wait that long. They don't wait till full retirement age. So it's and I see two questions in here, and I think we're going to hit these along the way. Give me just a moment. Full retirement age is that magic number where you get what's on your statement, but you also can keep working. If you choose to wait to full retirement age and love your job, or maybe work part-time, you don't have an earnings limit. You don't have a reduction in benefits. So full retirement age drives a lot of things. Next slide. So when you claim, this is what we were just talking about, it really, really matters. There's three types of claiming. You can claim early, and for a normal retirement benefit, early is as early as 62 for the worker and spouse. For a survivor or a widow, it could be as early as age 60. Benefits are reduced for claiming early, as much as 25%. If your full retirement age was 66, you claimed at 62, and say your benefit was $1,000 at 66, just for easy math, you're going to receive $250 less at 62. You're going to get $750, and it's going to be fixated at $750 for each year of cost of living adjustment and for your survivor. So let's really think about whether we absolutely have to claim early, but that's what most folks do. The earnings limit is fairly low. If you see the third bullet, $19,560 a year is the most you can make and not have to worry about your Social Security benefits being affected if you file early. If you go over about $20,000 a year, they're going to take back $1 for every $2 you're over, and it gets really messy paying the government back. So early retirement means you can only earn so much. It also means your benefit stays reduced and grows. Now, full retirement, which is that FRA, you have no limitation on how much you can earn. So if you reach 66 or 66 in 3 months, whatever yours is, you can keep earning, or you can go back to work if you had stopped and want to return. You can voluntarily suspend your benefits and turn them back on. Things of that nature. You can do all of that. If you claimed at 62, suspend at 66, you can revisit it at 70, and you'll get almost 100% of what you would have gotten of your FRA. So one of the questions we have is for divorce, how the government is in half if Social Security was assured. Okay, yes, we're going to hit that. And then will benefit increase after you get to full retirement age if you retire early. The benefit increase is based on cost of living adjustments across the board. So for example, in 2022, 5.9% roughly is the cost of living adjustment. So whatever your benefit is, whenever you filed, you're going to get that 5.9% for 2022. That normally happens in September. As far as cashing out 401k as soon as you retire, I see that question. I would not cash it out. We're going to talk about taxation. 401ks, IRAs, we see them as lump sums for all these years, but I'd like for you to start thinking them as income replacement sources. So if you build up $50,000 in a 401k, I would like for you to start thinking of that as a supplement, maybe $2 or $3 or $4 or $5,000 a year that you supplement your income versus looking at it as all one thing you cash in. You give up a lot to taxes. Next slide. Oh, delayed retirement. I'm sorry, not next slide. Let's go back, Allie. Delayed retirement, there's a benefit that if you go to full retirement age, and at least if you're married, maybe one of you chooses to delay even further, you're going to earn 8% simple interest up to 4 times. So 66, so 67, 68, 69, 70, which means 32% more money is on the table. A lot of times it's worth considering. It'll be more money in your pocket, but more importantly, it also could be more money for your survivor. We're often asking the higher earner to consider delaying a little longer, but let's go ahead and draw the benefit at least of the lower benefit so that we get some cash flow in now. Again, like Wanda said, no formula is a silver bullet for everyone, but consider the planning, because when you withdraw early or both spouses withdraw early, in the event of a death, the surviving spouse goes from 2 benefits to 1. They go from 2 benefits to 1. So whatever the higher one is, that's what you keep. You don't keep one and half of the other. You don't keep both. You're left with the higher of the 2. One of them is going to go down, and you're also going to go from married filing joint tax rates to single tax rates. So what often happens is taxes go up, income goes down. We want to plan for that. Okay, Allie. So this can get a little nerdy, but I'll just say spousal benefits. The benefit of it started back in the 30s in the Depression era, when oftentimes men were off to war. Spouses were at home taking care at home, not necessarily earning. So if you, for example, have a husband whose benefit at his full age is $2,400, even if that person files early, his spouse or her spouse is eligible to receive 50% of that $2,400 at full retirement age. So say the stay-at-home spouse or the lower earning spouse benefit was $800. What happens is when you go to file, that lower earning spouse actually will receive $1,200, 50% of the higher earner's benefit. It's a spousal provision. It used to be overlooked. Now it's automatic under the deemed file rule, but it really, really does help. Even if you've earned less, you're going to receive at least half of what the higher earner receives. Next slide. Yes, that question about 2023, there is a big COLA increase expected for next year. So that's huge. Okay, real quick, let's go through the 5 things you should know. Next slide, Allie. It may pay to delay. We talked about that. Underestimating life expectancy is huge, but 65% of us typically elect before reaching FRA. And it's just something I want you to think about or consider. If you do have IRAs, if you do have pension, if you do have permanent insurance, if you do have Roths, if you have 403Bs, if you have any other sources, there's very few places where you can get a guaranteed 8% increase. It's just worth considering if you can do that. The earnings test is still there. Again, if we file early, the earnings test, and you end up giving back benefits. So we want to be careful on that. And then taxation is where you're likely to get hit as well, because claiming a lower benefit typically means we're going to need more money from somewhere. So we start drawing out of our taxable accounts, or we go back to work and we start earning more money. That actually subjects your Social Security to more taxation than if you had left it and used those other sources first. It's also hard to change once you've gotten it started. Next slide. Ms. McKinney, for spousal benefits, it is for spousal benefits to be automatically applied. The higher earner must have already filed. And then when the spouse goes to file, you're automatically going to get the higher benefit, either your own or the spousal. So it does automatically happen now under the deemed file rule. You can see percentage wise, 41% of us generally, you're welcome, 41% of us generally file at 62. We want that money now. and that's normal. I see oftentimes, it's again, my fear, I'll say this as a segue. Most of my clients are over 60. I ended up succeeding a gentleman who passed away unexpectedly, and his clients were retired, and I serve a lot of widows. And strategies and accumulation and all that stuff is great, but what matters is what we call mailbox money. How many dollars hit the bank statement when he or she is gone? That's why I'm a big proponent of, if you can delay, because if you're going to get a $1,200 benefit, when if in a few years we could have gotten a $2,000 benefit, that's really going to matter to your spouse when there's no longer two checks. So just food for thought. Feel free to call me later. I'm happy to talk you through it. It may not make sense for everyone to do, but my basic philosophy is, for younger people, earn as much as you can, because they tax for Social Security up to 147,000 of income. Earn as much as you can, earn as soon as you can, but earn as long as you can, and also let that benefit grow as much as you can. Because once you turn it on, that is the benefit you have. That is the benefit your surviving spouse has if you have a higher one. Okay. Very few people, as you can see, though, wait till 66 or beyond. Next slide. Yes, we're going to hit planning for divorce in just a minute. This is that example that I just gave with the same benefit at 67. If you reduce it early to 62, look how much lower it is, $1,385 versus $2,125. If you wait it to 70, look how much higher it is. That's $600 a month more, $2,714. So when you come down, it's $740 a month less. When you go up, it's $600 a month more. There's a big reason to consider. And again, it's on a guarantee level. In the markets, we can't guarantee you that type of future income increase. We often get questions about break even. Well, why wouldn't I take it now? What if I pass away and don't get all my money out? That's one way to think about it. I won't lie to you. A break even analysis always breaks even about age 79 years old. So if you start early, you have to live past 79 for it to be worth it. If you start late, though, again, it's not that you're going to break even. It's that your survivor is going to have a stronger income. They're going to not have to deplete their savings so soon, or necessarily move out of their home. Next slide. Okay, I've hit this a lot. We won't go into it more, but this is a big thing to consider. Let's go to the next one. All right, important changes to Social Security. This doesn't come into play as much now, but back in 2015, there was some phase out of file and suspend, where you could file and then stop filing, and the spouse could get spousal, and the higher earner didn't take theirs and it grew. Don't worry about that anymore. The only thing I would say is, if you're 69 this year and you have not filed yet, you may want to reach out to a planner, because there are some opportunities for you to file, if you're married, a restricted application, which means you can get some money through the door and still let your benefit grow. And it's kind of like double dipping. So if you're in that situation where you're 68, 69 years old and have not filed, that's the only folks that would apply to. Let's keep going. Okay, so for divorcees, let's see if this answers your question. If not, we can go through it. A divorcee can receive benefits on an ex-spouse's record if you're unmarried and 62 or older, the marriage lasted at least 10 years, and you've been divorced for 2 years, and your ex-spouse is eligible for benefits. So if I was divorced, I have to remain unmarried. It does not matter if my wife were to remarry. I have to be unmarried. We have to have been married 10 years. and she would have had to been covered under Social Security. So divorced spouses are eligible for benefits under the former spouse. It works like spousal rules if all of those boxes are checked. It works like everything we just covered if all those boxes are checked. The provision for widows is to start benefits as early as age 60. So not 62, but as early as age 60. It still means a lower benefit. So what widows can claim 71.5% of the full benefit at age 60 if they really need it. This is an area where some planning can be done because there are ways to claim widow's benefits and let your own earned benefit continue to grow. So I would highly recommend that. It's free money on the table. You have to have been married for at least 9 months to qualify. So it's not an extremely long time for widows. Next slide. The question is, are these requirements reversed if the wife makes more money? They are just based on higher earner, lesser earner. Gender doesn't matter. So I'm using traditionally, and forgive me, many wives earn more, but just the traditional model. But it all works the same based on who earned more, and the lesser earning spouse should be getting at least half of that if married. Okay. What you want to know, some details on survivors, is as a widower, you're entitled to get 100% of what the higher earner would have received that's reached full retirement age. As a widower, you can start as early as age 60, and you'll get anywhere from 71.5% at 60, and then on up from there. Widowers who are caring for a child under 16 or a disabled child, there's 75% available. And the qualifying child may also get 75%. So again, we can't go into the weeds with this, but there are some additional checks, not just the widower's check, but there are some checks to the child who's under 16. There are some checks to the widower who's caring for that child. And yes, if there are multiple children, there could be multiple checks. Okay. Does this apply if you remarry? I'm assuming we're asking, does the widower piece apply if you remarry? As long as you wait until 60, you can come in under widower rules. The divorce rules, where you may be able to get a higher amount starting at 62 or 66, goes away if you remarry. So I hope that helps. If you get Social Security from this question, if you get Social Security from the divorce, does that mean alimony stops? Not necessarily. I have clients who are receiving alimony and Social Security. And let's dispel the myth that receiving from the divorce as a divorced person does not affect the other divorced spouse. It doesn't take half of theirs, or it doesn't take all of theirs, just because you're getting an equated amount to theirs. So theirs does not get reduced or changed. All right, we have questions rolling in. Let's go to the next slide and see if I hit any of these. Let's talk taxation, and then I'll go back to questions. There is a earnings income level for married couples. It's 32 to 44,000. For single individuals, 25,000, 35,000. Up to half your Social Security could be taxable. That's still a favorable tax situation because a pre-tax 401k or IRA is 100% taxable, right? However, it's best to not pay unnecessary tax. So it's only federal tax, there's no state tax. But if you can maneuver your income streams to stay within these limits, or maybe pay yourself first out of your other sources of income, whether it's pension and IRA, and delay your Social Security, you're also going to get more of your Social Security in the bank instead of making it half or up to 85% taxable. Next slide. This says, I retired at 56 from the federal government with special retirement supplement, 62 next year. Should I wait until 67? That's a great question, Ms. Lydia. I would suggest we talk offline because I know that my mother is federal. Much of my family is federal. That supplement is powerful. It could be powerful to delay, but that may not be best for you. We should talk about that. And then as a widower, can I still get my own later, but on here's after 60? As a widower, you can claim widow's benefits and then you transition to your own or the higher. So you're claiming the widower's benefit, which is calculated on his, and then you transition to your own, which you've allowed to grow, Ms. Letty. Okay, back to the slide. There are some pensions out there that will or could reduce Social Security, and you may have seen this on your statement. It's called Windfall Elimination Provision and Government Pension Offset. I'm not going to get nerdy on it, but essentially, if you worked for a employer that either did not withhold Social Security taxes, or you worked for the federal government, typically under the CSRS, this doesn't apply if you're under FERS, you were not taxed for Social Security. So unfortunately, Social Security is calculating your income and calculating your projected benefit, but it's going to be way less. So if we know, and if you're under those systems, you've been working for decades and you already know, but if you know that's the case, you're going to, say it says 2,000 in the statement, that benefit might come down as low as 300 to 500 because you didn't actually pay in as much as Social Security is projecting to have received from you when it all shakes out. Next slide. And I'm happy to walk you through that if you have more questions. Okay, let's go to the closing thoughts, the last slide. All right, so let's, again, at a very, very high level, Social Security is a critical component of any effective retirement income plan. Do not assume it won't be there. When it says the fund is going to be exhausted, it just means that the money in reserve has all come out, but there's new money going in. Assume something, even if it's 50 to 75%. And I say that because you want to have other resources. You want to have, like Wanda was saying, taxable, tax deferred, tax free. All of these buckets of money can be used to your advantage if we have them. If we spend all we're earning now and don't save for them or don't invest in real estate or something, we have our narrower options. So let's optimize Social Security if we can. Let's make the right decision about when to take it. Taking it early may be the best decision. However, that may not be the best decision for your surviving spouse. And then work with your advisor to assess your personal situation. There's no silver bullet. It will be a customized, we have a software that can run, there's 4,000 scenarios. It runs in a matter of seconds. So it is a very customizable and complex system, and it's not talked about enough. But based on ages, who reaches full retirement age first, whether you're married still, whether you're widowed, whether you're single. Even if you're single, that doesn't necessarily mean take it at 62. It depends on the other assets you have, depends on how much you're working and earning, depends on how much you love what you're doing. But generally, the longer you delay it, the more mailbox money you'll have on a guaranteed basis. And that's less you have to withdraw out of what you saved. And you end up having a healthier, fuller investment and savings account for the long haul because you don't have to draw so much out. Okay, I think that brings us to the end of the slide. It doesn't have to necessarily bring us to the end of the questions. I see another question. If I wait to take mine at 67, can I get the widower at 60? Yes, if you've met the other rules, Ms. Letty. I'm receiving a retirement check from my previous job. Will it affect my Social Security benefits when I retire? Not necessarily, unless it was under that windfall elimination provision. You didn't pay into the system as that covered employment, or if it's from CSRS.